What lenders typically are doing is not, will this company become the next SpaceX? What lenders are really doing is trying to figure out the likelihood a company will go on to raise their next equity round.
A lot of venture debt and even private credit is being used to fund the AI boom. And a lot of the servers, it's not like you can use them again in 3 to 5 years. These things are melting off the walls.
There are end customers who want these data centers and are signing contracts and willing to take all of the compute power. And if anything, you might argue it's supply constrained.
Why shouldn't you use your own general counsel to do the legal work?
General counsels are great. Where they tend to be less great is when they think they can negotiate the company's side of a legal process for venture lending.
I want to talk about what a reasonable legal timeline for like closing out a venture debt deal is.
For most debt deals, I'd say it's 6 to 8 weeks. Can it go faster than that? Sure. Can it go meaningfully longer than 6 to 8 weeks? Definitely.
Is this thing on?
Yesterday's price is not today's price.
Welcome back to Run the Numbers, the podcast where we talk with the world's top CFOs, investors, and operators about how capital actually gets allocated. I'm CJ, a tech CFO. My goal is to tease out the frameworks and deal mechanics that make you better at allocating and protecting capital. On today's show, I'm speaking with Marshall Hawks. Marshall is a longtime venture lender who's worked with companies like, Airbnb, Cloudflare, Fitbit, NerdWallet, Okta, Thumbtack, and Twitch. And he recently wrote a book demystifying venture debt, one of the most misunderstood tools in the startup capital stack. Marshall has done hundreds of deals across multiple cycles and has seen venture debt evolve from a niche? Is it niche or niche? Niche. Ben, I don't know. It's niche. A niche bank product to mainstream and sometimes overused financing instrument. In this episode, we'll go deep on the biggest myths about venture debt, what it is, what it isn't, why lenders underwrite likelihood of raising again more than world-beating outcomes. The venture debt sweet spot, why Series A and B companies borrowing 25 to 40% of their last equity round tend to be the core market, and when lending shifts to a percentage of ARR. Banks versus private credit, how funding sources change incentives, why private credit can be more transactional, and what that means for pricing and flexibility, how venture debt actually gets repaid, the 3 real sources of repayment, and why the next equity round is often the primary one, and doing deals the right way, realistic timeframes, legal costs, how many lenders you should negotiate with, and why your general counsel probably should not quarterback the process. Please don't do that. If you like the show, please remember to like and subscribe. It helps us with the algorithmic overlords. And if you're looking to hire the best finance and accounting talent, boy, oh boy, I would love to help you. I run a recruiting service that pairs you with thoughtful, qualified, they're just awesome candidates from our warm community of finance leaders. These are the people who voluntarily read credit agreements for fun. If that's of interest, shoot me an email, talent@mostlymetrics.com, and we can talk on to today's episode with Marshall Hawks. Marshall, welcome to the Run the Numbers podcast.
Hey, CJ. Nice to be here.
I feel like I'm coming up in the world because now I got real life authors on this show, Marshall. This is crazy.
Big time.
Marshall, congrats on the book launch. I read it all in one weekend, believe it or not. What's your background that led you to writing this? Because it wasn't a small undertaking.
Sure. It's my first book, maybe my only book, given the amount of effort that had to go into it. I came out of the venture lending and banking ecosystem, spent more than 2 decades at 4 different firms, working with venture-backed startups of all shapes and sizes. The bulk of that time was 16 and a half years at Silicon Valley Bank, or SVB. I left in March of 2025, about a year ago, to write this book and to see if I could kind of lift back the curtain a little bit on just venture lending as an industry for founders and entrepreneurs who might be navigating that for the first time and sort of want to learn more about it.
I joke all the time that there are a lot of books out there written about strategy, but not many written about tactics. But from my seat, CFO, the most valuable books have tactics in it. Like, teach me something that I can use tomorrow on the job. I feel like you really did that with this book.
I tried to do that for sure to make it actionable and, a reference book that is, somewhat evergreen. And it's actually modeled on a book of sort of similar ilk called Venture Deals. My book's called Venture Debt Deals. The original Venture Deals, written by Brad Feld, Jason Mendelson of Foundry Group, longtime venture capital firm based out of Colorado. The book is, I think, 14 years old now. First came out in 2011, but it really demystified venture capital and how venture capital firms operate and what's in the venture capital term sheets you'll see, because investors do it all the time. Entrepreneurs raise capital maybe on one hand, maybe two across their career, if that. So that book was a sort of seminal work that allowed people to maybe get rid of some of the asymmetry between the investors and the entrepreneurs. It's in its fourth edition. So I sort of tried to mirror that level of practicality, depth, maybe add a little bit more humor. No offense to Brad and Jason. They weren't quite as funny as I think I was in my book, and maybe allow entrepreneurs to learn about another tool in the toolkit for how to capitalize a business.
That's a great book. I remember I read it when I became, I think, director of FP&A at a venture-backed company for the first time. Because I was like, how are these guys even coming up with the valuations or choosing to invest in us? So that was helpful. Marshall, just for context, how many venture debt deals do you think you've done in your multi-decade career?
I wish I had maybe tracked that better, but it's at least several hundred companies that I lent capital to directly. And then you can imagine working at banks, which is where I spent all of my career. There's a whole litany of portfolio companies you have that are just bank clients for a chunk of time. So that's a much bigger number than that. A couple thousand probably that I've worked with and my teams have worked with directly. But the lending, where I was the lending point and providing capital directly, a couple hundred companies.
Couple hundred. Can you rattle off a couple of the names?
Sure. I've been fortunate enough to work with some really impressive companies that the success of those companies is very much on the shoulders of the entrepreneurs involved. Airbnb, Twitch, Okta, Cloudflare, Fitbit, Planet Labs.
That's incredible. Well, I want to talk a bit about venture debt and give people an on-ramp to start out here, and we can go deeper. But what is the sweet spot for venture debt lending?
Most venture debt, if you want to talk about it in terms of deal volume, happens at the earlier stages of a company's life cycle. So Series A, Series B, company that has raised institutional capital, but could be still pretty early on in their life cycle. That's where the bulk of the venture debt deals happen. Most of those are coming from venture banks like SVB and others. As companies get bigger, there is certainly a sort of a secondary sweet spot as you scale and things are really working, and maybe the model is repeatable and you've got big customer contracts and you're getting into the tens of millions of revenue. You start to access money from some banks, but also mostly from private credit firms, where the largest amount of dollars deployed happens at the upper end of the market, where people might borrow, 75, 100, $200 million in one go.
Marshall, you mentioned that startups have raised their Series A or B equity financing. They're prime candidates for venture debt. Can you speak to why it usually goes along with an equity fundraise, and maybe how much cash are we talking here that you can typically get?
Yeah, most of the venture debt deals, as we talked about, the majority of them happen at that early stage, right on the heels of equity validation or new money from investors coming into the company. Lenders like that because they get to sort of ride on the coattails of the diligence that those venture fund or funds did on the company. Insert your joke about venture capital diligence quality here, but you at least get the benefit as a lender that someone else, typically people who are a lot more technical than lenders are. Lenders can be somewhat technical, but you're usually not a CS major, engineering degree or anything like that in the lender landscape. So you want people who at least have done some modicum of diligence on the entrepreneurs, the founders, that not that these companies will be successful. Nobody really knows that for sure, but it's that these people at least have some credibility in going after the thing that they're trying to attack or build. That's sort of the reason number one. Reason number two early on is that when a company raises equity, it might seem a little bit odd that that's when they want to go borrow money, but that's when lenders are going to feel the most comfortable providing capital, particularly when a company, Series A, Series B, may not have everything figured out. They could still be even pre-revenue or pre-product, depending on the industry we're talking about. Even if the debt is meant to be runway extending capital a couple years down the road, lenders tend to like that company they're going to lend money to have, call it 18, 24 months of their own cash to start, even if the debt is going to be used to provide runway down the road.
I often joke that VC, their mindset is what could go right here for a home run. And a lender, they're thinking about what could go wrong here for something like to go to zero. And when you think about it, right after you raise an equity round and you have cash in the bank, that's the most optimistic time, right? Like it's the least downside because you have some money there.
I made a joke for years, I still do actually, that I used to watch Looney Tunes on Saturday mornings. My parents, when I was a young kid, and there was Yosemite Sam and the Roadrunner and everything else. And Yosemite Sam used to run around with a dark cloud over his head only, and it was just raining on him all the time. That's kind of like being a lender, right? You're just worried about what thing can go wrong, what kind of risks do we have. You're trying to use as many tools and data points as you can to mitigate that, including providing capital when a company's that early on the heels of equity coming in.
Well, speaking of data points, one of my favorite parts about your book was, I believe it was that 25 to 40% of the last raise is somewhat of a, what do you call it, a quantum in your world? That's kind of the amount that's typical to take out in debt?
What most lenders at any stage of that barbell we talked about, or whenever you're providing capital, one of the big risks you're trying to avoid is over leveraging the business such that the debt becomes problematic to repay, or that there is a question mark of whether new investors might want to fund, another round of equity because the debt is just so big. So one of the proxies to avoid what I just described is the rule of thumb you just laid out, CJ, where it's in the Series A, Series B stage of a company's life cycle. What you would typically see from lenders, again, mostly banks at that stage, is about a third of the dollars you've raised. You might be able to borrow via the venture lending ecosystem, the broader metrics of the business notwithstanding. Depending on the state of the equity market, if a Series A equity round becomes $200 million, yet the business is still very early, the percentage of an equity round goes down as the equity round size goes up. So you probably wouldn't be able to access, $70 million of debt on that $200 million equity raise. So the sliding scale, if you will, on the far ends of those percentages as equity rounds particularly get bigger.
You beat me to it, because I was going to ask about all these AI infrastructure companies who are raising hundreds of millions of dollars. They don't have a single dollar in revenue yet. I don't think someone who's a credit analyst is going to say, you know what, I'm still going to give them a third of that.
Yeah, you get a little bit more scrutiny for sure. That third really applies to, let's call it, equity rounds that are $50 million or less, where I think that math makes sense. And as equity rounds get bigger, or the scale of the business gets bigger, I think that percentage-based methodology doesn't really work as a rule of thumb. Generally, if a company's getting bigger from their own performance, you shift to something like a percentage or multiple of revenue, or ACV, TCV, something like that. If it's still early, you really would have to dig deep to get comfortable getting up to, bigger amounts of venture debt. Sometimes even zero revenue businesses could access a lot of capital. If you're a life science company, for example, and you've got a drug going through the FDA approval process, if you've hit certain gates in the FDA approval process, you might be able to access $50, $100 million of venture debt, that could be a very large percentage of your equity raised previously, because you're sort of de-risking or hitting milestones that really make the lenders get more comfortable. But in general tech land, I think those rules of thumb we were talking about apply.
Hey, thanks for listening. We'll be right back after a word from our sponsors. We've all been burned. We've all bought that enterprise planning tool that promised the world, only to realize 6 months later that we've basically taken on a second full-time job just to keep the software running. I want to talk about a company that was built specifically to kill that cycle, Abacum. I actually remember my very first conversation with their founder and CEO, Julio Martinez, over 3 years ago. Back then, they were just starting out in Spain. Fast forward to today, Julio moved the home base to NYC, and they're the engine behind finance teams at Strava, Replit, and JG Wentworth. Abacum doesn't turn you into a software admin. The integrations are actually self-service. You don't need a $300 an hour consultant to plug in your ERP or HRIS, and they're doing AI in a way that actually impacts the things FP&A teams are doing every day. Things like creating variance summaries, building formulas, and modeling scenarios. If you're scaling fast and you're trying to avoid that legacy platform trap, Abacum is the move. They're building the future of our tech stack, and they're doing it with a CFO's perspective. Go to abacum.ai to see it for yourself. That is abacum.ai. Well. Here's what nobody tells you about being a CFO. You'll spend 50% of your time on stuff that is killing your momentum. The best CFOs I know are business leaders who know how to drive growth in heroic fashion. But most of us end up spending our days buried in manual work. I'm talking about collecting receipts, reviewing expenses, and manually reconciling spend. It's painful. That's why CFOs need Brex. Brex built an intelligent finance platform that pairs corporate cards with built-in expense management, plus a team of AI agents to handle the manual finance tasks for you. That way, CFOs have more time for the high-impact projects that drive growth. The shit actually worthy of your CFO time. Bottom line, Brex is automating hundreds of thousands of hours of manual finance work every month across 35,000 companies like Anthropic, Coinbase, and DoorDash. Ready to spend less time buried in expenses and more time driving results? Check out Brex at brex.com/metrics. It is brex.com/metrics. Please, guys, how the hell do I have 3 kids in daycare? brex.com/metrics. You just launched a new AI product. The new pricing page looks great. I'm talking crisp. But behind it, last-minute glued code, messy spreadsheets, and running ad hoc queries to figure out what to bill. Customers get invoices they can't understand. Engineers are chasing billing bugs. Finance can't close the books. Well, with Metronome, you hand it all off to the real-time billing infrastructure that just works. Reliable, flexible, and built to grow with you. They turn raw usage events into accurate invoices, give customers bills they actually understand, and keep every team in sync in real time. Whether you're launching usage-based pricing, managing enterprise contracts, or rolling out new AI services, Metronome does the heavy lifting so you can focus on your product, not your billing. That's why some of the fastest growing companies in the world like OpenAI and Anthropic run their billing on Metronome. Visit metronome.com to learn more. That's metronome.com. It's funny because it feels like there's a difference in how lenders versus investors assess company potential and I guess underlying risk.
We talked about, again, the barbell, and I think at the early stage of a company's life cycle, so again, Series B or earlier, what lenders typically are doing is not, will this company become the next SpaceX or Anthropic or Apple or whoever, pick your best company. If we could do that, or I could have done that as a lender, I would have left lending, become an investor, and made a lot more money somewhere else. What lenders are really doing at that early stage is taking their best guess, and this is, by the way, more art than science, trying to figure out the likelihood a company will go on to raise their next equity round.
That's the key.
Which is different than, will this company become a gigantic breakout success? But what they're really thinking is, what are the odds this company, if it was Series A recently, if I provide some debt alongside that Series A, what is the potential for it to raise a Series B successfully in, call it 18 to 24 months? And I think arguably that's an easier question to answer, even though you may get it wrong sometimes, than saying, is this company that I'm lending money to at the Series A going to become in 10 years a multi-$100 billion public company? That's a very different question. As you get later in a company's life cycle and different types of lenders are involved at that point, most of the time, you are getting a lot closer to picking winners. If a company is pre-IPO, getting ready to file their S1 and maybe wants to bring on some venture debt, that's where you might be saying, well, this company is clearly best in class. It is the winner in the space, just because there's a lot more data and time. But again, early on, it's much more about, is this company just going to be able to raise its next round? And that's what's going to help pay back the debt.
And what are the 3 ways that lenders usually get repaid?
This tells me you definitely read the book. If you remember sources of repayment, every lender who is listening to this, if you have some listening, is going to groan at the thought of sources of repayment, because it's one of those things that lenders get grilled into them from their internal credit teams that help set credit policy, all the rules around what you can and can't do. In normal commercial banking, so where most companies borrow money, where most banks are providing debt, you want to have three sources of repayment, and they typically are cash flow from operations. So that implies that these companies are profitable.
Yeah, I was going to say, that implies they're actually making money.
Right.
Continue.
Then it's sort of assets on the balance sheet. So if you had, AR, equipment, whatever, sort of number two, and then, sale of the company as number three is sort of your tertiary source of repayment. In the startup ecosystem where venture lenders play, it's a small subset of lenders that do venture lending. Three sources of repayment are still important, but they're different. Typically what you would see, since companies in 95% of the cases, maybe even more than that, 99% are not going to be profitable, may not even be EBITDA positive. The first source of repayment is typically just cash proceeds from equity financing. So have you gone and raised that next equity round? Not that you're going to pay off all your debt in one lump sum. You might just pay it off over a 2, 3, 4 year period, or maybe at a big chunk at the end of the life of the loan, but that equity that a company is raising is what will continue to help service that debt. Number two is assets, sort of similar to the normal commercial banking land, though most venture-backed companies don't tend to have beyond the cash that they've raised, unless you're I guess in AI, these days it might be a little bit more CapEx intensive or hard asset intensive businesses that have, physical assets on the balance sheet. That's number two. And then number three tends to be some kind of sale of intellectual property of the business, which most of the time in venture capital backed companies, IP, there may be classical IP, but frankly, if a business hasn't been able to figure out how to monetize or found, product market fit, the odds that there's a lot of IP value there is pretty negligible.
I want to tie this to what we're seeing in the current markets today, because a lot of venture debt and even private credit is being used to fund the AI boom. And you think about, well, how do you get repaid, and what's an asset if you did need to sell it? What can you collateralize? And a lot of the chips that they're using, a lot of the servers, that's where the money's going. It's not like you can use them again in 3 to 5 years. These things are melting off the walls. Well, what's your take on that?
While I was at SVB, certainly that was being looked at and helped finance, where I'd say most of the GPU financing and data center build out that's been going on for the past 12 to 18 months has happened is at the upper end of the market, meaning big private credit firms, some of the biggest private equity players in the ecosystem, in the world, have come into the venture-backed company ecosystem and have been willing to provide hundreds of millions of dollars and in some cases billions of dollars to do this infrastructure build out. And that's not all just them being flippant about the risk. There's real asset value in if you're helping build out a building that's going to have server racks in it and GPUs, and you'll have to take your own perspective on what's the depreciation of, not just the economic depreciation, but the technical depreciation of how long these GPUs are going to be useful for, how quickly they're going to get repaid. But unlike, the dot-com run-up in the 90s into sort of the 2000, 2001, where it all fell apart, where there was a lot of fiber built out back in the day that was being built out kind of regardless of whether there was a customer who was going to use it, is that these days, at least right now, there are end customers who want these data centers and are signing contracts and willing to take all of the compute power. And if anything, you might argue it's supply constrained, where you need more chips in the ecosystem. So that's, I think, some of at least the thought process and bet that a lot of the bigger private credit firms have been taking when financing companies' AI sort of infrastructure buildouts. If I can generalize, obviously there's going to be a lot of specific variability depending on what type of company and who the lender is, but that's, I think, generally the thesis.
Well, it's a great segue, because the third voice in the room here is private credit. What's your definition of private credit?
Two big lending groups in venture lending would be the venture banks and then private credit, depending on the country you're in. This is probably more of a US-centric audience, but I was the token American helping run SVB Canada for a number of years, the Canadian branch of Silicon Valley Bank, where there's governmental players as well in venture lending, and that's true of some other countries. But in the US, largest market in the world, there's sort of venture banks and private credit. Venture banks are typically trying to use their venture debt in most situations as sort of customer acquisition financing. And they want to bring on a company early on, a Series A minted company. They might provide debt through the life cycle of that company if the company needs it. If they don't, they still get the benefit and they hope to be able to be the bank to that company for years, maybe the entire duration of that company's life cycle, and maybe work with that entrepreneur or entrepreneurs multiple companies over. Venture banks, they take their deposits, they lend that money out. That's their source of funding, sort of banking 101. You take cash from people who have it and lend to people who need it. Private credit mirrors venture capital in a lot of ways in how they structure their funds. They raise third-party capital from a variety of types of limited partners. Some of them are the same sort of pensions and endowments that you'll see in venture capital funds. Some private credit firms, they're called BDCs or business development corporations. They are publicly traded, and you and I could be a shareholder in those businesses. But there's a mix of private and public entities under the umbrella of private credit. So don't take the name private credit to say every company or every fund there is private. They take that third-party money and then they lend it out to companies that need it. Private credit writ large has become, I think, sort of the asset class of the moment of the last couple of years. And if anything, I think when we're talking here at the beginning of 2026, there's been a little bit of people poking holes, and is there too much private credit, and is there too much risk being taken? And that's private credit in the broad sense. I think in venture lending, which is a very narrow slice of private credit, you don't have quite the same concerns, at least to date. And again, these firms take money from third parties, they lend it out to startups of all shapes and sizes, and they don't do any banking. They don't care about where you bank. They don't use deposits because they're not a bank in the first place. One of their big selling points actually is that if you take money from a private credit firm, that you don't have to keep your banking at the bank that provided you the debt. If you're taking money from private credit, you can bank anywhere you want.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Here's a growth tax nobody talks about. Every new monetization model you ship creates a nightmare for your finance team. Add usage-based pricing? Now you're tracking consumption against commitments. Launch product bundles? That's multiple performance obligations per contract. Offer mid-cycle upgrades? Woo! Good luck reallocating revenue manually. But that's exactly where RightRev shines. RightRev is the revenue recognition engine built for companies that can't afford to let accounting slow down growth. When your rev rec is automated, your product team can ship new pricing without asking finance for permission. And your sales team can close creative deals without worrying about downstream chaos. To get up on my CFO soapbox for a sec, I love talking about creative pricing models, hybrid pricing, credits, tiered usage. But I've seen too many companies where the sales team is celebrating a huge quarter while finance is still trying to figure out how to recognize half of it. In a world where your pricing model might change 3 times next year, that flexibility is everything. If you want to scale your monetization without breaking your books, visit RightRev.com. That's RightRev.com, where modern monetization meets bulletproof accounting. Being a CFO, you know how much I love tools that actually make the lives of accounting and finance folks easier. One of my favorite tools right now is Rillet, the AI native ERP going head-to-head with NetSuite. Yes, someone is finally doing it. I met Rillet 2 years ago when they were still in stealth. Since then, they've absolutely taken the finance world by storm. Their mission is to make the zero-day close a reality, and they're actually doing it. Customers are literally closing their books at 1:35 p.m. on the first day of the month. They've got everything you need to scale your business. Complex revenue recognition, native integrations, custom reporting, multi-entity, close management, and much more. They're only a few years in and are already supporting NASDAQ publicly listed companies. Yes, seriously. If you want to scale your business on an ERP that wasn't built in the 90s, you need to check out Rillet. Book a demo at rillet.com/CJ. Oh, cool, that's me. That's RILLET.com/CJ. RILLET.com/CJ. Tell them I sent you there. Ali and the team at Tabs are building something that directly addresses one of the biggest headaches I see finance teams deal with today. Pulling data from your ERP, your CRM, your FP&A tools, and your usage systems and actually making it all work together. If you're running usage-based pricing or complex contracts, you already know how this usually plays out. Contracts live in one system, usage data lives somewhere else, billing happens in another tool. RevRec gets layered on top at month end, and finance ends up just reconciling everything by hand to close the books. This is exactly the problem Tabs was built to solve. Tabs is an AI-native revenue platform built for controllers and CFOs. It brings together data from your ERP, CRM, and real product usage into a single system of record, From there, it automates billing, collections, and revenue recognition without finance having to duct tape workflows together every month. If usage-based revenue is core to your business, this is the future of how billing and RevRec get done. Go check them out at tabs.com/run. That's tabs.com/run. And the big call out to me, I guess it's two things, is that the private credit funds, they're not holding your cash. So they are taking on more risk in that sense. And they don't have other products to sell you, right? They're just trying to make an IRR, an internal rate of return, similar to how a VC would. That creates a spread, though, between what you can get debt for, right?
The typical delta between, call it a venture bank, your average venture bank deal and a private credit deal, assuming they were sort of the same size, probably about 4 to 5% or 400 to 500 basis points in the interest rate and sort of fees, the differential there. Another part of the compensation, in fact, a big key component of the venture lending world is that lenders are typically going to take, in almost every scenario, a warrant in the company as well, sort of a stock option to a fund or a company. Depending on the situation, private credit firms might, want a larger warrant, depending on what's going on. The big thing to call out there, that difference in economics, is both the business models of the lenders, as you rightly called out. The venture banks and private credit are structured differently. They tend to also be playing at different parts of the market. Most venture bank deals are going to be sub 30 million at the high end, probably sub 20 or 15 million more commonly. And, private credit these days tends to not really show up or provide capital or be interested in providing capital over 30 million, certainly, but more like 50 or 60 million right now, given how the best opportunities probably in the market can sort of credibly ask for 50, 60, $100 million these days, given just the size of the private market has continued to grow. I mean, OpenAI and SpaceX are private and they're bigger than most public companies. So the private credit landscape, goes way higher than almost all of the duration of my career. It was rare you saw deals that were north of, 40, $50 million. And these days, that's kind of the entry point, to be honest.
That had been my rough rule of thumb, that private credit doesn't get out of bed in the morning for less than 50 million.
It's not that they're lazy or they don't want to work with companies. They both know that the bank market is harder to be competitive because of the pricing differential, but also, they have to make all their money on the debt. And that means not just the pricing is different, but they need companies that need that money and they need to borrow it right now. What venture banks more readily allow companies to do is to wait 6, 12, 18, maybe even longer months to decide whether they want to borrow the money that they've signed up to potentially use from a bank. Private credit, again, another sort of nuance, is that they, given the nature of the funds they've raised, want to see that money get used. So that kind of by definition means you got to have a company that has need for that kind of costly capital, because the other option is I have to go raise equity and dilute my own ownership stake and my employees' ownership stake and the existing investors. So instead of raising, 100 million in equity, I'm going to raise, maybe that amount or 75 million in debt to then use.
One of the fancy words that's thrown around is a syndicate, which to my knowledge is a group of lenders that work together to spread the risk and they each take chunks. Which group typically has sharper elbows? Do banks want to take the entire thing because it's a smaller amount? Do private credit funds want to say, hey, we're going to do a $300 million deal. I'll take 50, you take 100, you take 50. How does that dynamic play out?
I would say that most venture debt deals are not syndicated, meaning they're held 100% by whoever's providing them. Two probably exceptions to that. One is when a private credit firm is providing capital, they may themselves within their firm have a variety of pools of capital raised from perhaps different parties that may be named on, the documents. They may also be not named and you don't know that there's, multiple pools of capital. That's pretty normal and common, where just like a venture fund might have their early stage fund and a growth fund or an opportunity fund, sort of a similar dynamic. That's certainly one area where that might be happening. The other is if the deal size is so big, somebody wants a partner or partners to syndicate out the transaction to minimize risk. But I'd say most of the time, the private credit or banks are generally speaking, for all of the capital themselves. Where you get more syndicated transactions is in other types of lending that banks may provide. Stuff like big revolving lines of credit tied to your accounts receivable or your recurring revenue, or maybe equipment financing. There's sort of just different types of capital where the dollar sizes, given that the debt is less risky, gets way bigger, and you'll see syndicated debt deals all the time at that level.
That totally makes sense. I want to get down to the brass tacks. I hate when people say that. I don't know why I'm saying brass tacks, but let's do it. I want to talk about what a reasonable legal timeline for like closing out a venture debt deal is, because there are CFOs, CEOs listening right now saying, I want to start this, but I got to have some sort of backstop of how long this is going to take me.
Yeah. The legal process certainly is a big chunk. Sometimes it could be the majority, more than 50% of the time is spent on, legal work. For most debt deals, I'd say it's 6 to 8 weeks is a reasonable time frame from you've signed a term sheet and now you've gotten through all of the legal documentation process, documents are signed, and the dollars are available to you or funded to you. Can it go faster than that if everyone's motivated, working towards a specific time frame? Sure. Can it go meaningfully longer than 6 to 8 weeks? Definitely.
What's meaningfully longer in your career?
I mean, I've had a couple legal processes go out like a year.
No.
Which is kind of bonkers. Most of that was, and there was some renegotiation going on, both of the legal terms, but the debt terms too, so like the deal points. Usually that involved, maybe not the most experienced legal counsel on the company side, just a lot of things that aren't ideal, and no one enjoys that process, lender or company, but can go longer, understandably or justifiably, if the debt deal is large and the business is complex and there's a, perhaps very healthy legal back and forth. But again, I'd say sort of that 6 to 8 week time frame is a good rule of thumb. Certainly within, a quarter, you should be able to be done and the deal papered.
And maybe a different way to look at it. What's the optimal number of turns of sending the paperwork back and forth?
The number of turns is always a little misleading because it just depends on the volume of comments. You could have a lot of turns, and if the comments weren't all that significant in each one, might not be that big a deal. The other direction could be equally true. You might have one turn of the document, but the entire 100-page loan and security agreement, which is the main document you use to memorialize a venture debt deal, if all of it comes back and it's all red, meaning the whole thing's been redlined, like just because it's one turn doesn't mean it's going to be, faster, slow. That could be a disaster and take a year to get worked through, that kind of thing. Generally, 3 to 5 turns of the document is probably a norm, but I had a number of law firms, 2 law firms in particular, DLA Piper on the lending side and Fenwick and West on the company side, write a little bit of content in the book, Venture Debt Deals. They both sort of bristled when I asked the same question of them, like, what is the number of turns? Like, well, the turn thing doesn't really, it might be synonymous with, time frame and dollars spent, but it can vary pretty widely. So I don't know, 3 to 5 is my best guess.
You mentioned law firms there. Who's typically fronting the bill for these deals to go down?
Sadly, that is that the company tends to pay the legal expense of both parties. So the company's own costs and then the lender's costs as well.
I hate that part. That's always irked me, particularly about venture capitalists. They're giving me all this money, but then I got to pay your $50,000 in legal fees.
As someone who's now no longer in the industry, I certainly appreciate that sentiment. And I think a few of the banks, depending on how early they're doing a debt deal with a company, might be willing, or occasionally are willing, to pay their own legal bill. What they tend to also say, though, that goes with that is we have to use a form that's kind of non-negotiable. So we can't sit and go back and forth on a bunch of legal negotiation, perhaps driven by the company. We'll pay for our own costs, but here's the form and you have to take it or leave it. So that's sort of the trade-off.
Inside baseball question. If you're in my shoes as an operator, should you negotiate for a cap?
A legal cap, I think, is always a good idea on how much cost is going to go towards lawyers. But you just need to know that the legal cap itself is, you got to pick the right number with enough cushion to make sure everybody feels comfortable to agree to it. And then probably more importantly, whether you had a legal cap or not, what I would say is, proactive communication between, company and lender, or, between all parties, including the counsels involved, the law firms. Where are we at? How much cost has been incurred? Sort of keeping tabs as you go through a process is probably equally, if not more so, going to help corral legal costs, or at least maybe bring the business parties back to the table to say, hey, this is getting out of hand. Like, we got to focus on the things that really matter, and maybe the lawyers don't need to be involved, and we got to figure out some business points just with the principals and not law firms.
Well, this is an early contender for put this on a bumper sticker in 2026. Why shouldn't you use your own general counsel to do the legal work?
General counsels are great. Where they tend to be less great in my and almost every lender's experience is when they think they can negotiate the company's side of a legal process for venture lending. It's not that they don't understand the law. It's not that they don't understand commercial lending. They just don't do it at a velocity or volume to know what is normal, what is a lender possibly even going to be willing to negotiate, and where are they just going to say, we will never change that ever, pound sand. I have never had a process in my 2 decades plus of all the hundreds of venture debt deals I've done myself, had a process go faster because a general counsel was involved, or be less expensive. Because what ends up happening is you go, 7 rounds back and forth, and you say, listen, we can't agree to something, or, we just don't do this. And then inevitably either the deal fails, which can happen. More commonly, the general counsel then says, fine, I'll call our either corporate counsel or bring in the likes of a Fenwick and West or whoever. And so now you've spent all this time yourself, and you've got to bring an outside counsel on top of that who has to get up to speed on what the negotiations were. And so you end up just burning more time and more money than it's really worth.
Marshall, we talked about the legal component of this. I'm a CFO, and I get a lot of questions around which forecast should I provide, because you got your I'm raising equity capital, pie in the sky. We're going to hit $100 million in 3 years. Then you got your annual plan of what the board is holding you to. But then you also have your overdeployed quota plan. I want to zoom in on what plan I should give to my lender. I'm guessing this should be a little more conservative.
I think lenders generally want to see what you think is the most likely, which is probably a more conservative view. They don't need to see the up and to the right asymptotic sort of line that equity investors generally like to see, even if they know it's not necessarily likely to happen exactly that way. If you have sort of your base case, your downside case, your upside case, like showing a lender all 3 of them is not a bad thing. They want help in understanding your thinking as a CFO or a CEO. Like, how are you guys modeling this data? We know the data is not going to be perfectly right, if not even close, but we want to hear how you are thinking about the business model. What are the underlying sort of levers that are going to drive either underperformance, sort of outperformance just on plan? And that's really what a lender's kind of getting at. So whatever you have, I don't think it's bad to share sort of everything. I would say if you're setting, venture lending does not tend to have financial covenants involved until you get to the really upper end of the market at $75, $100 million from private credit firms. But if you are setting financial covenants, you certainly want to guide it to a place where you are using your base or downside scenario, and you want to get everybody comfortable with a covenant level or covenant levels, whether it's tracking performance to plan, revenue, your balance sheet, something like that. You want plenty of margin in those levels such that you are meaningfully off plan and everyone agrees that that's true at the start. You don't want to have arbitrarily, too tight a covenant package. Again, that's not something that's that common in venture debt, at least the totality of deals done, but just something to think about.
What should people expect in terms of reporting cadence? So many will send, a minimal flash note each month to the board, and then they'll do more of a comprehensive, wholesome package on a quarterly basis and then annual. What does it look like when you're working with lenders?
The main thing that lenders are going to ask for, that you are going to be on the hook for as a company who's borrowed money, is you're going to need to send in the monthly financials.
So you need financials on a monthly basis.
Yeah, company prepared monthly financials, unless you're a public company or about to be a public company, maybe it's quarterly, but almost every lender wants monthly. You got to send an annual company prepared financials, historical, as well as if you're getting an audit. When the audit's done, you need to send in the projection for the new year, whenever it's sort of ready or updated. That's somewhere in Q1 typically. There's some other things in that. What I would say is what you just described, though, of like the flash monthly, a more comprehensive quarterly and annual sort of board level package, is that some lenders ask for that sort of board deck or board pack as well. Even if they don't, I would encourage most companies and CFOs and operators to think about your lender at that board level type of reporting, that even if they don't require it, getting your lender more information, you can remove HR sensitive stuff, maybe something if you were, evaluating lending options that doesn't include that lender, you can take that out. But like all the rest of it, giving more information to a lender is not going to freak them out. Actually, it makes them more, even if there's things that aren't working in the business, it just makes you more comfortable as a lender that you know what's going on in the business. Everyone's running around with the hair on fire and there's always something breaking. And if you don't hear about that from the company directly and you have to start asking about like what's not working and what is and what is not and what are you trying to solve, you sit there having to grasp, what do I not know? Versus if I get all of the board reporting, is like, I might see things that aren't working, but actually that makes me more comfortable in almost every case because I don't have to go chasing CJ to find it and ask a bunch of questions. Again, just treating your lender sort of as a board level participant, even if that's not required, I think has mostly upside and very little downside, assuming you've chosen a good partner to work with in the first place.
Sage advice from Charly Kevers, CFO of Carta, who's one of the first ever guests on my podcast over 200 episodes ago. He said, CJ, bad news should always travel fast. Pick up the phone. I'm guessing in your shoes, Marshall, throughout your career, you've had finance leaders or CEOs pick up the phone and call you with bad news.
You expect it. Even some of those great names of the companies I worked with that we rattled off at the beginning of this conversation, they didn't take straight line paths to the success that they are today. And, everyone talks about the, 10-year overnight success and all that kind of stuff. And people can lose that in the high points of the tech business cycles we all go through right now with AI. Most good lenders know that there's going to be ups and downs. There's going to be things that don't work. There's going to be surprises. There's going to be things, competitor or, new competitors showing up and what they do. Getting them information about what is and is not working quickly is, assuming you chose a good partner, that should be a positive thing in the mind of the lender as opposed to a negative. If they have to hear at the last minute when the company's already been dealing with the problem for days, weeks, months, that something is wrong and they didn't hear about it till then, that's going to freak them out way more than if they heard about it hot off the press. Something broke. Somebody left the company that was critical. Just all that stuff. And here's what we're doing about it. That's what lenders want to hear proactively.
And I think that's what I was poking at. You get the call and you're like, oh, that sucks. Something's wrong. But then you're also kind of like, oh, they think of me as a partner here. And I know more about the business than I did before. So actually, it's less of a downside risk because I'm fully informed.
100%. And maybe even in the best case, a lender might be able to help with something, whether that's capital related, maybe, but actually it could be we've got this problem. Do you know anybody to replace the VP of sales who just walked out? You'd be surprised if you treat your lending partner with that kind of transparency and candor, what you might get out of it.
I want to talk about Twitch because this case study was one of my favorites in the book. It made everything that you were talking about real. You did a number of deals with them, right?
It was the first company that I started to work with when I joined SVB in January of 2009. When you recall that timeframe, that was kind of when the financial world was ending. Ironic, given what happened to SVB about 13 years later. But the first company I was sort of handed as a relationship manager, VP, was Justin TV. And that was the precursor to what became Twitch. And I sort of closed that first transaction. And then we did 4 total deals to them over their lifespan before they got acquired by Amazon.
That helped them minimize dilution, right?
There's plenty of others, but Twitch is just such a well-known name, given they've continued to be sort of the de facto esports company in the world, really, to this day, that venture debt gets bandied about. There's a lot of people who talk about it online with a declarative, oh, it's terrible or it's great. I think Twitch is a great example of a good outcome. Both the company that they built a phenomenal business, the venture lending alongside didn't necessarily drive the success, but it helped when the company was able to achieve that success. It helped everyone who was involved own more of the business than they would have otherwise, because they would have, in fact, we had a variety of conversation with the company pretty later on where, they were thinking about, do we raise equity? Do we take on a little more debt? They did a mix of both, first of all. Second of all, the debt, though, when you look at the modeling that we did after the outcome, when Amazon bought them for just a little bit under $1 billion, $100 million of equity value to the existing shareholders. So that's, again, the founders, that's employees, that's the existing venture investors. Then had they gone out and raised equity.
I think you worked with the Canadians for too long, Marshall, because you're being awfully modest. That was the headline I was trying to tease out of you. I mean, 75 million or more in equity value, that changes employees' lives by just having a better financial capital structure.
Venture debt is certainly just a tool. It can be used well, it can be used poorly. But when used well, balanced out with equity and everything else, it can have a meaningful impact on individual humans' lives if you have a good outcome down the road. And even if you don't have a good outcome, it can sort of help a company survive longer, maybe not crash and burn as hard. You can over-lever a business and there can be problems from venture debt for sure, but that's not unlike venture capital where you can raise too much money and have other problems from VC dollars too.
Well, gearing towards a close, where do you think we are on that spectrum when you look at 2026 and how many deals are being made today? Are we getting over our skis, or is it more of a nuanced message where you have to look at it sector by sector? There's a funny quote that there are no atheists in foxholes and there are no atheists at 11x debt to EBITDA. And if you think about some of the companies that are taking on these huge private credit deals now, I mean, correct me if I'm wrong, but these are like of a scale we've never seen before.
Definitely of a scale we've never seen before. That is for sure. I think the jury's out on whether it's a bubble or a bad thing. I think the difference with some of the upper end of the private credit landscape, mostly private credit, there's a few banks that play up at the high point or these higher dollar amounts too, is that these companies have real businesses. I mean, it's not the dot-com boom. It's not like there's nothing there. They have end customers. They have people with multi-year contracts. They have physical assets that are being, built out that might have, value unrelated to the business. So real business is there for one. For two, most of these bigger transactions tend to have some financial controls or financial covenants. So these big funds, private credit funds who are providing this capital aren't just doing it blindly with no guardrails. Probably a better question sort of remains to be seen just how good long-term partners all of the private credit players, particularly some of the newer ones in the space, are going to be over time, because I'm sure you and I would agree that even though there's some world-changing AI businesses being built already, that not all of those companies will succeed and not all of them will become, liquid and public companies. So when those companies that don't work go sideways or down, how do both equity players and lenders react to that? And some of the people in probably both camps, actually, venture capital and venture debt, are newer. And doesn't mean they're going to be bad partners, doesn't mean they're going to be, bad at what they do, but the potential for a wide range of reactions when things aren't going well is probably pretty high. And it'll be interesting to see.
Last one I got for you. You put a lot of work into this book. What was the most surprising or counterintuitive takeaway you arrived at while researching and writing? Because you got to look back at 20 years of doing it yourself, but also just the industry writ large.
I think the thing I had to balance when writing this book is when you've done this job and been in this industry for more than, certainly a few years, in my case, a long time. I had hair and it wasn't gray when I started. The things that I might think are not novel or interesting or worth writing down, sort of trying to balance, like putting yourself in the beginner's mind of a brand new entrepreneur, founder, CFO even, who hasn't ever navigated the venture lending landscape. Took me a while to figure out like the right balance. I hope I've struck that balance. Readers like you and others will decide whether I have or not, but make the book accessible to people while not, completely dumbing it down too much. That was something that was a hard thing for me to check and balance, sort of what I thought might not be worth writing about. When talking to entrepreneurs and a bunch of GPs actually as well, you realize most people don't have the depth or detail of the venture lending ecosystem and sort of the business models of the players and what motivates these firms to do what they do. Sort of writing that down and sort of getting people to affirm that that was worth reading took some time.
I write a newsletter I struggle with myself because there's a ton of stuff out there in the 101. And there's a lot of stuff written on like the 701 that's way over my head. The sweet spot is something like the 201. where you can onboard someone and get deeper. And my favorite part about the book was the inside baseball and the incentives, because I can look up in a dictionary or I can Google a couple of times the definitions of what private credit is versus venture debt. But to know why certain players act in the ways they do, right, wrong, or indifferent. Like a lot of these people are just normal people driven by incentives. That part, I think, was the most illuminating to me.
That makes me happy with my choice of college degree. I'm an economics major by training, which probably not the most useful degree, to be honest. But one of the things you certainly remember is that incentives matter and they drive behavior. And that, I think, continues to be true across this industry and, humanity in general.
Awesome. Well, Marshall, where's the best place for people to get the book?
Anywhere books are sold. If you want the easy button, you can go to either Amazon, where you'll find venture debt deals in all the formats. You can also go to venturedebtdeals.com, my website. That'll get you anywhere you want to go. Those are probably two places that are easiest to find the book.
Thanks for spending time with us today. This has been great.
It was great to be here. Enjoyed the conversation, CJ.
Run the Numbers is a mostly media production. Yelling and intro by Fat Joe. Artwork by Meg D'Alessandro. Show is executive produced by Ben Hillman. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog way too much ice cream and has a history of net operating losses. LOL. If you like this podcast, hit subscribe and give us 5 stars. It will take like 2 seconds and our algorithm overlords love it. Drink water, call your mom, and have a great day. Peace.